Welcome to your Midweek Energy Update. I'm Mark Roach with FutureWise Energy, bringing you the latest developments across the upstream sector since last Friday. Oil prices have gained momentum this week, climbing over 1% on Wednesday following new U.S. sanctions on Iran and a reported drop in domestic crude inventories. Last Thursday saw a 3.4% jump to $64.60 per barrel, though ongoing tariff concerns continue to create headwinds for global demand. In Europe, natural gas prices fell 2.5% on Tuesday as steady LNG arrivals have temporarily eased supply worries. This price relief comes at a critical time as the market navigates seasonal transitions. For the first time in 4 weeks, U.S. energy firms added to their rig count, according to the last Thursday's Baker Hughes report. We saw one additional oil rig, bringing the total to 481, and one gas rig, now at 98. The Utica shale basin added 2 rigs, reaching its highest level since February 2024 at 13 active rigs. Despite this modest increase, the total rig count remains 34 rigs, 5% below last year's level, which I believe is a clear indicator that producers are maintaining capital discipline despite improving price conditions. The U.S. Interior Department made a significant move last Friday, initiating a 5-year offshore oil and gas leasing program that seeks public input on potential new zones, including previously restricted Arctic regions. This represents a substantial policy shift under the Trump administration, potentially opening new frontiers for development. Chevron has already capitalized on offshore opportunities, announcing its first oil production at its Ballymore project in the Gulf of Mexico, or Gulf of America. This project highlights the continued potential for deep water assets despite the industry's recent focus on shale. The mood across the patch remains cautiously optimistic but wary. OPEC output increases and tariff-related demand concerns have U.S. producers considering production cuts if prices fall below $60 a barrel. On the regulatory front, Texas is considering stricter rules for oil and gas waste pits through House Bill 4572, reflecting the ongoing environmental pressures facing upstream operations, even in producer-friendly states like Texas. What we're seeing is an industry at a crossroads, benefiting from supportive federal policies while navigating market uncertainties. The sanctions on Iran provide short-term price support, but structural challenges do remain. The modest uptick in rig counts suggests operators aren't rushing to deploy capital despite some improvement in pricing. Offshore opportunities are expanding, but these projects require substantial investment and longer development timelines. Smart operators are positioning themselves strategically, maintaining financial discipline while selectively pursuing growth opportunities, particularly in the Gulf of Mexico or Gulf of America, where the regulatory environment is improving. Well, that's your upstream update for this week. Mark Roach, FutureWise Energy, signing off.